Hi everyone, in this video I'm going to talk about 4 ways that you can use to convince your parents to invest into mutual funds. So the mutual fund industry today is about 30 lakh crores in asset size and represents about 1/4 the size of the banking industry. Currently in the United States, the mutual fund industry is 4 times the size of the banking industry. India is also expected to show a similar growth trajectory. But while the mutual fund industry in India is growing at a rapid pace, it is still not a very popular option among the senior citizens of our country. The reason for this is that, in their minds, the mutual fund industry is strongly linked to the stock market and they've had a bad experience of investing in the stock market. While this may be partially true, it still doesn't explain the dangerous diversification that most investors in India have today. According to the RBI, 77% of an average Indian's wealth is tied up in the real estate. About 10% is tied up in gold and the rest of it is majorly invested in fixed deposit. So since senior citizens value minimal risk, putting all their eggs into real estate and fixed deposit is also not the most prudent thing to do. Because the real estate industry today is in bubble territory and the fixed deposits are not even able to beat inflation. Given this background, there is ample opportunity for senior citizens to explore other modes of investment, such as mutual funds. Hey guys, welcome back to Finance with Sharan. In this channel, we explore the incredible world of finance and economy and how it can help us better our lives. If you're new here, please subscribe to my channel so that you can get more videos like this as soon as I make them. So let's get started with the video. So the 4 tips that I'm going to talk about have personally worked for me as well and have helped me to convince my parents to invest into mutual funds. Tip number 1. Introduce them to debt mutual funds. So mutual funds are broadly of 2 categories. One is the equity mutual funds and the other is the debt mutual fund. Most of us think that mutual funds only mean the equity market. But the reality is that the size of the debt mutual fund industry is larger than that of the equity mutual fund industry. So debt mutual funds are similar to fixed deposit. The difference is that they usually offer 2 to 3% better returns and also have better taxation benefits. So how fixed deposit works is that you give your money to the bank and then the bank lends it out to other companies. In this process, the bank is the middleman and takes a cut of the profits. However, in a debt mutual fund, your money is directly given to the company which is in need, and the fund manager of the debt mutual fund decides which companies to give your money to. So that's why a debt mutual fund can offer you better returns than that of a fixed deposit. So conveying this point to your parents about mutual funds would help you get the ball rolling in the right direction. So within debt mutual fund, you can first introduce them to the banking and PSU debt mutual fund, because this debt mutual fund invests only in the banks and the top PSU companies of India. This would give your parents a sense of comfort as to where their money is getting invested. You could also show them this graph of SBI's banking and PSU debt fund. As you can see in the graph, the returns are fairly consistent over a 5-year period. In the case of a fixed deposit, this graph would be a straight line. But as you can see here, this graph is also closely resembling a straight line with a little bit of volatility towards the end, especially due to the pandemic. But the important thing to note here is that this fund has offered nearly 9% of compound annual growth rate over a 5-year period. Comparing this to a fixed deposit, which is only offering about 4.5% to 5% today, this is a much better investment option. Tip number 2. Show them the impact of taxation. Most investors only look at pre-tax returns when evaluating their investment options. But the taxation among different asset classes, such as a mutual fund versus a fixed deposit, can make a very big difference to how much money you're eventually going to get.
So guys, to illustrate my point about the impact of taxation, I have built this Excel model to compare the returns shown by a fixed deposit and a debt mutual fund. So I have assumed an initial investment of 50 lakhs. And I have also assumed that after 10 years, both fixed deposits and debt mutual fund would give a similar kind of return. So what we can see here is that after 10 years, both the investments reach 1.5 crores. But in reality, this would not be the case. Debt mutual funds have historically shown better returns than fixed deposits. They usually have 2 to 3% higher returns. But in order to drive the point about the impact of taxation, I have assumed that both debt mutual funds and fixed deposits give us similar returns. So the profit that we get here is a simple subtraction, that is 1.5 crores minus 50 lakhs, that is 1 crore. Now we come to the indexation benefits. So indexation benefit is only applicable to debt mutual funds. So indexation benefit is nothing but taking inflation into consideration. So as we all know, as the years go on, the cost of goods also keep on increasing. So what we can see here is that something which costed us 50 lakhs 10 years back costs us 97 lakhs today. So that is the implication of the index cost. So now the benefit of taking index cost is that our taxable profit reduces. So you can see here in case of fixed deposits, the taxable profit is still 1 CR. But in debt mutual funds, since the index cost is much higher, the profit that will be taxed is only 52 lakhs. And now coming to the tax rate, for fixed deposits, a 30% tax rate will be charged. especially if you are in the 10 lakh plus income bracket. And for debt mutual funds, a 20% taxation will be charged. So that gives us a taxation amount of 30 lakhs for fixed deposit and only 10 lakhs for debt mutual funds. So you can see here it's a 3 times difference in the tax which is charged by the government for your fixed deposit investments versus your debt mutual fund investments. So now finally, when I compute the post-taxation returns, you can see that debt mutual funds offer 2% better returns solely based on the taxation benefit. However, if you had considered even the actual return shown by debt mutual fund compared to a fixed deposit, this number would be even higher.
So if your parents are still not convinced after talking about tip 1 and 2, then you probably lost the game and there's not much you can do about it. However, give them some time to think about all the things that you've said and then go back to them with tip number 3. Tell them that the corpus might not be enough to sustain their future. So most of us Indians think that once we hit 60, all of our investments should go into 100% safe products. But the problem with that is that most of the safe products in India are offering only 4 to 5% returns. This is lesser than what the inflation rate is in India. And if you cannot beat inflation, the cost of goods will rise at a faster rate than the rate at which your money is growing. If this happens, then things which were affordable to you a while back will slowly start becoming unaffordable to you. But the human brain is not able to fathom the concept of inflation. To further illustrate my point, let me explain with the help of an example. Let's say that a 60-year-old has about 30 or 40 years more to live. If you assume an inflation of 5%, which is what we have historically seen in India, something which used to cost 1 rupee at the age of 60 will cost 7 rupees at the age of 100. So as you can see, the cost of goods have increased by 7 times over a period of 40 years. Let me give you another example. Let's say that a person in his 60s is spending about 30,000 rupees per month for his expenditure. By the time they turn 70, that expenditure would balloon up to 65,000 rupees per month to sustain the same kind of lifestyle. So as you can see, inflation can have devastating effects on the amount of money that we will be requiring to sustain our lifestyle. So if your investments are not able to beat inflation, you will not be able to maintain the same lifestyle as the years go on. So most of the 100% safe investment options in India today, such as the savings account and fixed deposit, are offering only 4 to 5% returns. This is exactly equal to the inflation percentage as well. So in effect, your money isn't actually growing, but is only matching up with the cost of goods every year. So driving this point to your parents might make a very powerful impact on why they should explore other investment options as well, apart from fixed deposits and savings account. And finally, tip number 4, get them started with a small amount. Of course, all of this information might be very overwhelming to them in the beginning. So ask them to get started with a very small amount. For example, if they have a 50 lakh corpus, maybe help them to get started with investing with 2 or 3 lakhs in a debt mutual fund. And then periodically show them how the debt mutual fund has performed with respect to their other investments. This will gradually give them more confidence to invest more money into mutual funds. This is exactly what I did with my parents a couple of years back. And today, they're very comfortable investing in mutual funds all by themselves. So now let's talk about why you need to convince your parents to invest into mutual funds. Number 1, what if your parents' money run out? Who is going to take care of them? That burden is eventually going to come on you. There's nothing wrong with that. After all, our parents have taken care of us all these years. But it would obviously give them more pride if they could take care of themselves all by themselves with their own money, instead of having to rely on you. And number 2, what if their money doesn't run out? That money is eventually going to come to you as your inheritance. And that money is going to help you to build your own retirement corpus, and then your children, and then their children, and then so on and so forth. So helping your parents manage their finances is actually going to help you and your future generations. So guys, I know it's not easy to try out all the tips that I talked about, but it's definitely worth a try. Please let me know in the comment section below if you were successful in convincing your parents to invest into mutual funds. So guys, if you have stuck with this video for so long, I'm sure I must have added some value to you. If so, then please smash that like button and subscribe to my channel. Also hit that bell icon next to the subscribe button so that you can get more videos like this delivered to you as soon as I make them. So guys, with that I'll wrap up this video and I'll see you in the next one.